What does it take to design a production-grade digital asset platform? In this course, we'll connect tokenized securities, stablecoin settlement, custody, compliance, and integration into the architecture package decision-makers need to trust, approve, and deliver. We'll build the enterprise blockchain architecture layer by layer. First, we establish the foundations. Then we choose platforms, design tokens and settlement, address custody, compliance, security, and risk, and finish with production readiness and your capstone. This course follows a dependency chain, not a set of isolated technical topics. Market needs define what the platform must support. Architecture choices then shape token design, issuance, settlement, custody, controls, and operations. Each decision narrows the next set of choices. In regulated digital assets, success depends on aligning business value, legal obligations, technology, risk management, and production readiness from the start. Use the course from your own starting point. If blockchain or tokenization is newer for you, move sequentially and protect the foundations. If you are intermediate, go deeper where your platform, market, or role needs the most leverage. If you are advanced, use the material as a reference to pressure test your architecture, controls, and product choices. As you go, pause to sketch decisions, record assumptions, flag risks, and capture questions for compliance, security, and engineering. Before designing technology, we need to map the market. Digital issuance is not one product. It includes tokenized securities, funds, bonds, equities, real-world assets, and settlement instruments such as stablecoins, deposit tokens, and CBDCs. Around those assets are operating roles: issuers, custodians, compliance teams, auditors, trading venues, and settlement providers. Once you understand what moves, who controls it, and how it settles, the architecture choices become much clearer. The urgency around digital issuance comes from friction in today's markets. Traditional issuance often depends on separate ledgers, delayed settlement, and manual reconciliation between parties. Tokenization can improve this with a shared record, faster transfers, automated servicing, clearer audit trails, and more flexible ownership models. But blockchain is not magic. Institutional value only appears when compliance, custody, interoperability, privacy, and operational resilience are designed in from the start. Digital assets are not a single category. A tokenized bond, a fund interest, a carbon credit, and a real estate claim each carry different rights and obligations. The architect's job is to model those differences explicitly. What can the holder do? Who can transfer it? What lifecycle events occur, such as coupons, redemptions, audits, or expiry? And how does settlement become final? Tokenization starts with the asset, but the design must bring law, operations, compliance, and technology together. Even when assets are represented as tokens, the token logic can be very different. A bond needs issuance terms, coupon payments, transfer limits, and redemption at maturity. A fund needs subscriptions, redemptions, NAV processing, and coordination with administrators. Equity tokens must preserve shareholder records, voting rights, corporate actions, and ownership controls. Across all three, regulated markets usually require permission transfers, so eligibility checks and compliance rules become part of the operating workflow. Real-world assets are most compelling where markets are hard to enter, slow to transfer, or dependent on paperwork. Tokenizing private equity, real estate, commodities, or carbon credits can improve access and automate workflows. But the token is only as trustworthy as the off-chain system behind it. You still need verified custody, credible valuation, registry integration, audit trails, transfer controls, and legal agreements that make ownership and settlement enforceable in the real world. Once securities are tokenized, the next question is the cash leg. What settles the transaction? Fiat-backed stablecoins can be fast and widely available, but they depend on private issuers and reserve quality. Deposit tokens and tokenized bank money bring settlement closer to regulated banking rails. CBDCs, especially wholesale versions, could provide central bank finality. This choice affects liquidity, counterparty risk, compliance obligations, reconciliation effort, and the experience for investors and issuers. Settlement also has to be designed into every event in the asset's life. At issuance, investors pay, allocations are confirmed, and tokens are minted. In trading, The key question is whether asset delivery and cash payment happen together through DVP or atomic settlement. During servicing, eligible holders receive dividends or coupons. At redemption, tokens are burned and cash is paid out. Corporate actions add more changes, so reconciliation and compliance checks must follow the asset end to end. A digital issuance platform is an ecosystem of responsibilities, not a single-party system. Issuers create assets, and investors hold or transfer them. Custodians and wallet providers protect keys and approve transactions. Agents and administrators keep records, process distributions, and manage lifecycle events. Regulators, auditors, compliance vendors, exchanges, and market makers add oversight, assurance, access, and liquidity. The design challenge is mapping each responsibility to permissions, integrations, controls, and accountability. Minting tokens is only the beginning. Primary issuance proves the asset, qualifies investors, collects payment, and delivers tokens into custody. Secondary activity then requires controlled transfers, liquidity access, matching or routing, and settlement under compliance controls. Servicing keeps the instrument alive through payouts, redemptions, corporate actions, reporting, and audit evidence. The architecture decision is what you operate yourself, what partners provide, and where integrations must be tightly controlled. The point of market analysis is design readiness, not memorization. Each market choice becomes an architecture question. What kind of asset is being represented? What makes settlement final? Who can mint, transfer, approve, or custody? Which regulations require controls, audit trails, privacy, or resilience? When you can answer those questions, the platform stops being abstract. You can define components, integrations, permissions, operating processes, and risks with much greater precision. You now have the landscape map for digital issuance: asset types, token rights and lifecycle rules, settlement rail trade-offs, and participant responsibilities. Use this context to evaluate platforms and shape token models with confidence. Next, we turn that landscape into an enterprise reference architecture.